The most obvious danger of inflation is that if prices rise faster than incomes, people can afford to buy fewer goods and services. This can mean a fall in standard of living. It destroys the value of cash and discourages saving. In the worst cases, countries suffering from high inflation have to abandon their local currency and adopt the currency of a more stable nation. This happened in Zimbabwe after hyperinflation in 2008 forced the country to use the US dollar. In March 2022, the inflation rate climbed to 8.5%, based on the US Labor Statistics Consumer Price Index data, the highest we've seen since 1981. It looks like the rising prices of consumer goods are here to stick around. Such huge inflation spikes contribute to market volatility and economic instability, creating turmoil in the traditional stock market. In turn, investors seek new investment opportunities that will help them hedge against the risks that come with rising inflation. Hello, and welcome back to Only Pay. We'll be discussing about how to beat inflation in 2022. Be sure to watch all the way to the end. If you're new to the channel, then hit the subscribe button below from our life-changing content. While the central bank usually encourages low inflation rates of 2 to 3% through adopting different monetary policy strategies, an inflation rate hike of 8.5% can throw the economy and your portfolio off balance. Here's how you can beat the record high inflation trend this year. 1. Diversify your portfolio with alternative investments. One of the most vulnerable asset classes in times of inflation is cash. For example, if you hold $500,000 in cash, considering an inflation rate of 8.5%, you'll lose $42,500 in purchasing power. So, a great way to avoid such financial losses is to put your money in alternative investments such as real estate, oil, gas, fine wine, alternative mutual funds. Such alternatives are usually less volatile to the market turmoils. It is also one of the best luxury good alternatives. While the S&P Global Luxury Index has decreased by 8% in the past year, fine wine portfolios increased by 5.28%. Another inflation protection strategy used by many successful investors, like Warren Buffett, is putting capital into real estate infrastructure and real estate mutual fund establishments. That's because infrastructure assets tend to preserve their value even in times of inflation. 2. Consider bond investments like Treasury inflation-protected securities. Fixed income markets are heavily influenced by inflationary pressure. So instead of investing in fixed income stocks, you can consider investing in bonds, which are usually less inflation sensitive. Even though bond yields are much lower, this asset class can help investors diversify and balance their portfolios. Additionally, bonds like TIPS, Treasury inflation-protected securities, are inflation-proof since their principal increases as the inflation rate rises. While they are more expensive than ordinary bonds, because they offer inflation protection, they're suitable if you're looking for short to medium-term capital gains. TIPS are also a good option for investors who are nearing retirement age and want to avoid risking their savings. 3. Make tax-efficient investments. Try to maximize tax efficiencies on all your investments. To do that, you can adopt different tax-efficient investing strategies like putting assets that lose a smaller percentage of their returns to taxes in taxable accounts, putting assets that lose a higher percentage to taxes in tax-advantaged accounts. 4. Put your excess cash into stocks. Instead of holding onto your excess cash, you can invest it in company stocks or a stock mutual fund. This has proven to be a great way to protect yourself against rising inflation and help adjust it. Why? When you invest your money into company stocks or stocks mutual funds, businesses can pass along the increased company costs to consumers in the form of rising prices. In turn, this shields their profit margins from inflation, resulting in stable or even steadily increasing stock prices. 5. Look for consumer staple stocks with strong pricing power. Consumer staples, such as energy and food, have strong pricing power. That's because they can easily offset any increased costs by implementing price increases without affecting demand. As a result, The stocks of consumer staples companies are stable even during surging inflation. So putting your money in commodity stocks is usually a safe bet during inflation. 6. Avoid investing in companies with high labor costs. During inflation, companies that are dependent on their workforce, such as healthcare and retail, try to raise wages to retain and attract employees. These raises aim to match the higher consumer good prices. However, the growing wages encourage even higher price increases, creating a spiraling inflation trend. Also, most experienced investors like Warren Buffett usually avoid investing in such companies since they require a huge capital influx to stay afloat in economic crisis. When choosing company stocks, make sure to screen the company and understand how dependent it is on its labor force. Aim to invest in companies that do not require a lot of capital to cover increasing labor costs in times of inflation. 7. Avoid risky, high-growth stocks. Rapid growth companies that are dependent on interest rates are at high risk during inflation. That's because the Federal Reserve of the United States usually increases interest rates to discourage borrowing during higher inflation periods. In turn, emerging companies can be negatively affected by the higher interest rate. If you're looking for promising high-growth companies, ensure that their growth comes from stable operating leverage. Such companies are usually less affected by the surging inflation and the resulting interest rate hike and have stable stock prices. 8. Keep track of your spending and try to save. The Consumer Price Index surge indicates the increase in commodity prices, and these higher price trends decrease your purchasing power and lead to higher inflationary pressure. To avoid getting hit by the higher commodity prices, just start keeping track of all your expenses and try to find cheaper alternatives to some of the goods in your basket. Do without some of the less essential things you buy on a regular basis. Set a monthly budget and try to stay within it. 9. Open a savings account. Opening a savings account is a good way to earn some interest on your money, even during higher inflation periods. Just open an account and put at least 6 months' worth of savings in it. Even though most traditional savings accounts do not offer very high rates, earning a modest interest rate is better than nothing. Alternatively, you can try searching for online savings accounts since these sometimes offer a much higher interest rate than the average. If you are looking for short-term savings, you can also deposit some money in a certificate of deposit. 10. Research past inflation trends. Researching past high inflation trends can help you identify some current and future inflation patterns. Such patterns include stellar commodity stock performance, stability of the energy sector, good performance of real estate and other alternative asset classes. The skyrocketing inflation trend in 2022 has changed the way we live and invest. To ensure you beat inflation in 2022, you need to adjust your portfolio and investment strategies to the changing economic environment and stock market trends. If you enjoyed this video, don't forget to hit like and subscribe. And be sure to turn on bell notifications so you don't miss any videos just like this one. Please give us your thoughts in the comment below, and we'll see you in the next one. Thanks for watching.